So Chris, we had you here last year, the first token summit, and you talked about valuations of tokens and cryptocurrencies. Actually, the focus was more on currencies, and it was one of the most popular presentations. And now we are, you've evolved your thinking and your work into cryptoeconomics and token engineering and token economics. So tell us how you evolved and what are you, let's talk about now token economics and token engineering.
I think the important thing to realize with the investigation of valuation is it really began as a way to better understand how value was moving through these networks and therefore how the token will behave. And so it really began from the perspective of design of these tokens. I think that given the speculative frenzy that 2017, or at least the back half of 2017 represented, people started to focus more on using it as an investment framework, which ultimately there will be use there. It's just right now the markets are irrational enough that there may not be use. And so what we're seeing currently is a lot of focus on this idea of token engineering. So there was an inaugural token engineering summit on Sunday, just a small event with people thinking about, okay, what are the tools we need bottom up to design these systems? And then cryptoeconomics being the science of studying how those systems perform.
What was the outcome of the, can you give us any insights from that?
I think the number one takeaway is none of this exists yet. There are no well-defined tools for bottom-up creating a crypto asset monetary policy that clearly maps to the use case. And I think over time we will have more of that. You know, historically what we've seen is there's a lot of behavioral inertia, right? If you go to when Bitcoin first launched, a lot of the initial altcoins also had a logarithmic supply curve that converges on some fixed amount. And there was a lot of inertia around that. And then things came out that started to burn Bitcoin, right, to create a new asset base. And so then people experimented with that. And then Ethereum came about, which did a crowd sale mixed with a long-term inflation rate. And so people started to experiment with that. So it's kind of like there are these epochs of behavioral inertia around monetary policies that appear to work without a first principles exploration of what maps to what use case, and I think that's where we're getting to now, but we're really just beginning that journey.
But how can you model something that we don't understand very well? That's been my criticism of all these models, because this is such an evolving stage here we are at, and when I see all these spreadsheets and token modeling, it's really, are we trying too hard here to model something that we still are not completely understanding?
Well, this is where we go to, okay, are we creating models to design the token up front, in which case you can actually boil down to some pretty simple primitives the precise behavior that you're trying to incentivize. And so Michael Zargam from Block Science or Trent from Ocean have been doing good work in that realm. Then in the valuation realm, you know, you can go down the relative valuation path, which are things like network value to transactions ratio, NVT, or any number of ratios. And I think there we're starting to see, or we're definitely seeing patterns emerge. And this is where I would argue the theory will follow the fact of the market. And those are probably where there's most utility in the valuation conversation. And then with the fundamental or intrinsic valuation conversation, you know, it has taken us decades to get equities right, and equities are continually evolving. So I think we'll continue to see, you know, complexity, attempts, back testing, and hopefully converge upon something that makes sense.
Okay, so Joel, you've been thinking about governance. So what's the proper way to think about governance, and how are you thinking about governance now?
So if you think of blockchains or crypto networks as these kinds of games, as some people have described them, especially within the realm of game theory and so on, I think of the cryptoeconomics of the game as the rules of the game, and then the governance function of these tokens as the power to change the rules of the game. And the thinking around the intrinsic value of governance comes from understanding that if these networks are going to become the fabric of the economy over time, of these information networks, as they become more valuable, as more economic activity flows through crypto networks, then the value of governing those networks and changing the rules, having the power to change the rules of those networks becomes very valuable. And the thinking is that over time, especially on the supply side of these networks, but also on the user side, as we have more to ride on these networks, as we have more at risk on the rules of these games, then the power to change those rules is going to become more important.
So we were talking earlier, and you told me now we are seeing more and more governance tokens as opposed to transactional tokens. So is this the equivalent of a new use case where today the talk is about utility tokens? So is the governance token a type of utility token, or is it another class of its own that is different? And can you give examples?
I'm actually most excited about tokens that combine both functions. So tokens that serve both as a transactional token and a governance token. And the reason I think that's quite significant is when you look at how modern capitalism works, we've separated the transactional function into fiat currencies or just currency in general, or into a different asset class, and we've changed the power function into capital. So shares in a company really represent the power to change the rules of that company, for example. And the devil is in how those two asset classes evolve over time. Power tends to accrue value over time, while transactional functions tend to decrease in value over time as more people come into the system. And tokens that serve the function of both transaction and power, and transaction and capital, have, I think, an opportunity to distribute power more evenly across the network because everyone is sharing the same asset, unlike in modern capitalism where most people live their life in currency, which loses value over time, and a very small group of people live their life in capital, which appreciates in value over time. I see tokens that combine both as the combination of currency and capital into a single asset.
What are some examples? Are we talking like Oscoin, or what else?
I think a pretty good example out there is actually ZeroX. So ZeroX serves both functions. You have the transactional function of the ZeroX token for paying transaction fees to relays for facilitating the service provided by the network, but it also gives you power to vote on the changes to the rules to the ZeroX protocol. And so what ends up happening is this interesting effect where over time, as more activity flows through that network, you're distributing the power to change the network more evenly across the people who have more at stake. So if you have a relayer that's processing 30% of all the transactions in the network, then they're going to accumulate a proportional share of the tokens, and so they will accumulate a proportional share of the power to change the network. If a second relayer comes to market and offers a superior service and transaction volume moves to that second relayer, then that relayer is going to accumulate more voting power over time. And so as that network grows, then you get a distribution of power based on how everyone is contributing to the network, as opposed to concentration of power when you separate both functions.
And we also recently announced our involvement with Decrypt, which has a strong governance component to it. And I think the stats, because the network has been around for 2 years, give a few examples of what we're looking for in a governance token, and really target this idea that governance can be a store of value. And if you think about, say, the coveted nature of governing the United States over time, that is something that has gotten more and more expensive over time, even though the number of seats have remained the same. And we're actually seeing that with Decred, where the ticket, so you can think of a ticket within Decred as very similar to gas within Ethereum. So with Ether, within Ethereum, you use Ether basically to purchase gas to run a smart contract, and within Decred, you stake Decred to get a ticket to participate in the governance process. The price of those tickets have gone from 2 Decred at the launch of the network to currently 90 Decred. The percent of the asset base staked to participate in the governance process has gone from roughly 20% to over 45%. So you have increased rate of participation in governance, and you have increased value or increased covetedness of participating in governance, which show the increasing value of this network. So it's literally the stakes to govern the network grow with the size of the network, which is a trend that we would expect to see going forward.
So is there such a thing as the right monetary policy that would balance and capture the supply and demand sides? Does it enter the equation, and how?
I think we're at a very early stage of experimenting with monetary policies within crypto. I think one of the most important things, though, is that your supply side, so in the case of Bitcoin, the miners, your supply side earn the token, contribute work to the network to earn the token, because that is what actually creates the utility of the network. Something that scares me with ICOs is you really bring in capital from elsewhere that you then have to centrally manage. And you have to centrally manage that capital to hopefully get people to build out your network, as opposed to just having an asset that has a market price and then having a monetary policy that says, okay, all of these economic agents, if you contribute to our network, you will earn this token, and in that way, the network actually grows its utility. And so that is a much more decentralized model where you don't have to centrally coordinate anything. You just set the monetary policy in place and let the economic agents come to you and contribute to the network, and then that scales over time. As the price of the asset goes up, you can actually purchase more utility power as opposed to having sold all of it up front in an ICO.
Okay. Are there any examples of tokens or marketplaces that are doing a good job or getting in the right direction, where we can start to see these metrics and say, well, this is what it means quantitatively?
Well, I think a really interesting one that just launched is LivePeer, right? And LivePeer, so historically within crypto, we have said, okay, we will target an inflation rate and hopefully get some kind of behavior out of that. And if you think about mechanism design as reverse game theory, really you should start with, as a goal, your desired outcome, and then modulate the inputs to hit that desired outcome. And one of those inputs is the monetary policy. And so with the case of LivePeer, they said, okay, the behavior we want is roughly 40% of these tokens staked, and we will modulate the inflation rate to meet that goal. So if 50% are staked, we will bring down the inflation rate, we'll bring down the reward. Or if 30% is staked, we will ratchet up the inflation rate, ratchet up the reward. And of course, there's a balance to this, but I really like the idea of laying out, first and foremost, what is the behavior we're trying to get, and therefore, what is the monetary policy that will incentivize that behavior?
Great. Joe, let's talk more about governance. I like to think of governance as having different layers. Do you agree? And what would be the different layers that we have to think about in terms of governance?
Well, actually, going back to Decrypt, Decrypt's a good example of that layering. So Decrypt started out with at the bare metal of the consensus protocol. Instead of, whereas Bitcoin is just proof of work, Decrypt implemented a hybrid proof of work, proof of stake system, where the proof of work layer is producing blocks very much in the same way that Bitcoin is, except each block has to be approved by the proof of stake layer. People who stake either approve or veto blocks. And that is the first, the bottommost layer that introduces checks and balances to the relationship between users and miners. And then from that base, they have expanded and created new layers of governance on top. So for example, one layer above, there's, they have a system now called Politeia, which is a mechanism that allows end users or regular users to submit proposals to the Decrypt network and have the proof of work, the proof of stake layer vote on those proposals. And then on top of that, they can build more and more tools. And it does get us into a conversation of which functionality or what functionality can you program into the consensus protocol on the form of on-chain governance, and which are more human problems that you need to build more user-facing interfaces for people to participate in that.
What do you think of on-chain governance?
It's a debate. I agree that it's difficult to encode. Governance is such a complex problem, and it's difficult to come up with a set of rules that you can encode from the beginning. I do like how Decrypt set it up, because it starts from a very elegant, simple perspective, and then you can build it up as needed. Now, there is also the question or the debate around, is it the right time to invest in governance, or when do you end up designing, or when's the right time to implement these features? And the way we think about it, it's never too early to invest in governance. And by the time you realize you need good governance, it's usually too late. And so we like to invest in teams that are thinking about these problems early on, and particularly as investors in tokens, when you're holding a token, the question of what are your investor protections and what are your rights as a holder of that token, that is a governance question. And so we like to see teams implement these features early on and evolve them over time. They don't have to be perfect from the beginning, but it has to start from a solid foundation.
I was going to ask you a question about investments, because both of you had largely an analyst role last year, and now you are an investor with a very serious fund. So how are you looking at what you are interested in? What are you looking at in the next 6 months to 12 months? What piques your interest?
Well, I would say the broad framework with how we approach things is technology first, and technology is table stakes. But you have to clearly have solid technology to begin with, but it's table stakes and it's not defensible because everything is open source here. And then building a layer up, it's the token engineering and cryptoeconomics perspective of what are the unit economics for the supply side versus the unit economics for the demand side. If the supply side has to bring hardware, that's very different from just installing a client on my existing computer or contributing work, say like Steemit or whatever it may be. And then on top of those two layers, which both have to be robust, you need good governance. And the thinking here being governance is a protection against being forked to death. If you don't have good governance, if you alienate your token holders, then your network will continually fork and will have a hard time capturing value. And so this is really where governance becomes very defensible. I think that in the things that we're focused on right now, I would boil it down to human-facing infrastructure. So I personally have some concerns around how commoditized machine infrastructure may get, and actually humans are stickier as users, and humans become attached to things. And we currently are in the developer era of crypto. It's largely too early to expect mainstream applications and mainstream use, but there are a lot of developers coming to the space facing a lot of problems. And so what are the protocols out there that will make these developers' lives easier and that will capture value over the long run as opposed to being commoditized at a base layer?
So is there a list of, like a criteria list that you like to check off when you look at companies in terms of their crypto economics? So you like the technology, and now you can have your, what are your test points for the soundness of the token functionality or role? Or
well, I would say on the supply side is, does it make sense, right? How much money can the supply side expect to make in a given period for the work they're contributing? And would I, if I were considering the supply side, find that to be an appealing scenario? And so, for example, we're diligencing a distributed compute protocol right now, and there's this concept of core hours, and it's $180 per core hour, and over a year, and my computer may have 4 cores, so I would make, say, roughly $800 from providing my computer to this network. Those are some meaningful unit economics to the supply side, and then if you can get the supply side on the board, there is an argument that supply can create its own demand. So it really starts, I would say for us, with investigating the supply side, and then if a good enough service is created, that is where the demand side comes on.
There's another side of that, which is that the monetary policy and the cryptoeconomics of the network, designing those is very difficult, and it takes a lot of trial and error to get there. And the first version of any of these systems is probably not going to be what it ends up looking like 2 years in the future, 3 years in the future. So these economic models have to evolve with the network as more data comes in. When you're in the design stage, before you release the network, you're operating on assumptions. When you go live, those assumptions change with observation, and then it becomes a question of changing the rules, which brings us back to governance. If you don't have the right mechanisms for changing the rules in a way that includes the community and how you change those policies, then you're going to have a hard time evolving the network over time, which is why we focus so much on both aspects of it. We need to define the rules of the game early on in a way that's advantageous to the network, but also have mechanisms to change the rules over time.
I agree with that. I think it's an evolving pattern in terms of governance. It has to evolve, and that's really how we get there. On that note, I know we could have talked for another 20 minutes, but unfortunately we are running out of time. But thank you very much. It was a great panel.
Thank you for having us,
Thank
William.
you.